Well, welcome everybody. Price Headley, thrilled to be with you here just after the 11:30 hour Wall Street time on this Monday. It's October 20th, 2025. We're starting to see earnings come in, starting to see some of the reactions to that. Of course, we've seen our share of volatility the last couple of weeks with, the Friday before last, of course, the Trump tariff threats about from on China about potentially adding another 100 percentage points onto their tariff rate, then him backing off of that, and then of course you've seen some of the back end fill volatility this past week, talking about regional bank crises and stuff. I mean, given that, you'd say the market's held up incredibly well to theoretical worries. The volatility index popped up over 20, hit almost 28 on Friday morning before popping back down just under 20 here. But, bottom line is that, it's all about, kind of saying where are stocks headed next. Trends in motion tend to stay in motion. We're going to share with you how we find fresh breakouts with not one but two indicator techniques paired together to give you double the confirmation, double the confidence in your options purchases. These are cheap options trades, $1 or less, meaning $100 or less to control each 100 shares of stock. That gives us a lot of leverage, but we're not using the shortest term options here. We're typically going out multiple weeks before expiration. And we're looking for not just doubles, but triples and quadruples, ultimately taking out partial profits at each of our profit targets. So let's go ahead and get things started, walk you through how this works, show you a bunch of case studies and how you can start preparing to take advantage of these Grand Slam option setups as well, with future real-time email alerts, and we can get text alerts to your smartphone as well as a Grand Slam options subscriber. Now, remember, as we get started, the information provided in today's presentation is based on our proprietary research. It's intended for illustrative purposes only. What we talk about here should not be considered specific advisory recommendations. As you know, stock and options trading have large potential rewards, but let's face it, they also have large potential risk. We're going to talk about both sides of the coin today, and I think we've got a really unique way to manage risk based on time rather than price volatility, but saying you get a window of time for a trade that should start working. If it's not, that window closes, you get out relatively quickly, recoup a lot of capital, and move on to the next trade that's got a better chance to get that rocket ship takeoff much more quickly. Remember, the past performance of any trading system or method is not necessarily indicative of its future results, and do see our terms of use on our bigtrends.com homepage for more information here. Now, we're talking about $1 or less options. That means, when you buy a $1 option, it means you're paying $100 to control 100 shares of stock off of just one options contract. And the theoretical leverage on that can often be 100 to 1 or more with these relatively cheaper options. So we're not just looking for doubles here. We're looking for ultimately the potential to have a four-bagger, potential 300% gainer, quadruple your original investment as our final target. But we're going to take some risk money off as we hit other targets before that. So we'll walk you through that. We believe that while one indicator is good, two indicators both firing together as saying that we've got a fresh breakout across two different techniques will give us double the confirmation and double the confidence in betting on the breakout, not being a fake out, but actually being the takeoff point to something much more dramatic, potentially more powerful that you can ride and benefit from. So we give you a bunch of case studies and chart examples when it works, also how we get out when it doesn't, and how you can target up to 4x returns using monthly options. So we're not using weeklies or really short-term options. We're using options that often have about a month before they would hit their expiration, give or take. And we're also going to give you a super special that I've just approved to actually give you the potential to get twice the number of Grand Slam setups. Hang with me towards the end to get that super special bonus time and bonus amount of setups here. But let's go right on into it and get looking at the charts here. And here's one for Apple. It amazes me when you look at the big names like Apple that you would think Apple, being one of the biggest market capitalization stocks out there, would be a slow mover. But when Apple starts trending, it's one that historically has done really well on our Grand Slam system. And in fact, that's part of what we look at is like, if we're going to make a trade, we need to know that that stock on our system has had a good history, in this case of a buy signal. Look at all the past buy signals. These are hourly charts, by the way, so we're looking at every hour candles here. But the idea is that, we're looking at this and saying, okay, go back over at least 10 years of past data. Now, the past never guarantees the future. We all know that. But we tend to think it's a guide for which stocks have essentially what I would call the personality to say that strength begets more strength. And that's usually the growth stocks. And by the way, weakness can beget more weakness. So we can get put trades with these setups too. It's just a function of, okay, are we getting the institutions starting to pour on the buying power, putting the pedal to the metal and starting to pour on the gas? Or are we getting them bailing and rushing out across these indicators at which we would pick up the potential for a put trade? So the point of this is that you can see Apple's breaking out, gap up on a prior Friday morning. This is back last month. We got this signal. Apple had been kind of dead money for a while, and then it started to take off again. It stalled there in the 230s, and then it gaps up over 240. When it does that on the first hour here, you can see that. Let me mark this up here. That okay, there's your gap, right? A lot of times you're going to see that we will follow a gap, if in this case to the upside, if we're getting the confirmation that both of the indicators are breaking out together. Now, what are the indicators here? The blue line in the middle panel here is what's called the CCI, the Commodity Channel Index. Now, you say, why use a commodity-based indicator for stocks? The principles are the same. Donald Lambert, who developed the CCI indicator back in the early 80s, I was noticing these patterns, and then when I read his work more closely, he was looking for the same kind of stuff, that the breakouts tend to be unusual. When they break out, they tend to stay broken out. They tend to have much more power after that first surge to the upside. Now, we're also using on the bottom panel here, we're using Larry Williams percent R, percent range indicator, right? So these are two techniques that I did not develop, and I give credit where credit's due, because my view is that anything that works, that tests well and trades well based on a lot of history, is something I'm interested in trading and interested in you getting a piece of, from the standpoint of, you want history to be on your side. You want to know that the odds are stacked in your favor. There are no guarantees in trading. And let's face it, we're playing a probability game, right? So the idea is that if you're playing a probability game, your biggest consideration on the front end should be, if the odds are stacked in your favor, you should never be all in on any one trade, right? I mean, it's look at any game, any sport, any favorite can still get beat, right? Anything can happen, even to the theoretical best hand out there in the card game, or in this case, in the options trading game, right? So we have times where we love a setup on Apple, we get in, and it just doesn't fire. We're going to talk about, if it doesn't, how we clean them up and move it on. But it fires enough in our favor compared to against us that we like taking these trades whenever Apple signals. Here we've got both of them breaking out together. So we're hopping in at the start of this second hourly bar here when Apple is trading in the neighborhood of just under 242. Now, what do we buy when we're buying an option? First rule, of course, is that we're buying about a month out. So this was happening back in September. We're buying the October monthly options. They actually just expired this past Friday. We were long gone, of course, after just a couple of days in this trade last month, right? So we don't hold them into the expiration. In fact, we don't hold any of our Grand Slam options trades less than 2 weeks to go before expiration, right? So our objective is not to try to cut it close to expiration. It's actually to try to hop in and hop out reasonably quickly. But notice, to buy a cheap option on Apple when it's at under 242, we're buying out to the 260 strike call, going out about a month until the expiration. So here we are, just over 18 points out of the money, or roughly about, as you can see here, some 7.5% out of the money. You say, wow, you're needing a 7.5% move to get paid. Not necessarily, although you can see the next day when it really shot up as high as 256, we almost got to the strike price. But a big part of this is that our first goal, when we get our breakout, both the indicators are check. CCI and percent R are both breaking out here. And in a matter of several hours, this is why we want you in quickly. When we call it these real-time email alerts and text alerts to subscribers, as soon as we get a signal to say, hey, go buy the October 260 calls. Our average entry, by the way, was 84 cents. Now, we might have said get in up to 90 cents or something like that, but we track all of our subscribers' average entry prices in the time after we get into call out a new trade, and give you enough time to get in and say, okay, you had enough time to get in, and the average entry price was 84 cents, $84 to control each 100 shares of Apple. Of course, 100 shares of Apple would have cost you over 24 grand, right? So you've got theoretically more than 250 to 1 leverage in this situation. Now notice, course, there's going to be time erosion, so we don't expect to get all that leverage. But in just a matter of hours, the stock has popped from under 242 up here to about 245, right? So a 3-point pop in our favor is only about a 1% move in Apple stock. Just over a 1% move gets us a 100% gain. So our first target is achieved. What do we do when we get a 100% gain on any Grand Slam trade? At 100% or more, the first target, we sell half of our position, right? So if you were buying, say, $1,000 worth of Apple calls, these calls that we called out for $84 a piece, that would mean that you could get in to 11 contracts in this case, right? 10 would get you 840. The 11th would put you at 924. The 12th can't be put on because that would push you over your $1,000 cap. Okay, so you get 11 contracts on for $924. Okay, so when you do that, you say, okay, well then what's my first objective? Sell half my position. If I've got an odd number of initial contracts, 11 contracts, we'll sell one more than our 5.5 contract average, right? We'll sell 6 contracts. We'll round up essentially to get a little bit more than our risk money back in that case. But the goal, of course, is get your risk capital back. And guess what that allows you to do? It allows you to be not just financially freer, because now you have no risk. Even if the rest of your position went to nothing, you could not lose on that trade when you've gotten your risk money back into your pocket, into the safety of cash back in your account, right? So the idea of this is that you should be free psychologically as well. You now have the ultimate staying power to give this thing a chance. Now, we don't need a lot of time, as it turns out, because the stock gaps again to the upside the next day. And by the way, you can see the essential pattern that I want to see. When I get these breakouts on CCI and %R, my golden pattern here is that you want to see them stay in their quote-unquote overbought thresholds. You can see %R gave a couple of what we call retests, right, at that first low, and then later, after we were already out, it gave another retest. We were already long gone after it gave that next retest. But the idea here is that target 2 is getting hit in that first hour of that next trading day, somewhere up here near 250 to 252. Target 3 is getting hit close to 255. Notice we are not at the 260 strike call yet. We're not at the 260 strike price yet, I should say. So the idea is that a lot of people assume, well, it's got to get up over 260 for you to make any money in this trade. And that's not the case unless you're riding it all the way to expiration. We will not ride these to expiration. So we're taking advantage of the fact that it's going from 7.5% out of the money to only maybe a couple percent out of the money. So that 5% move is where you're getting that 100, 200, and 300% leverage, right? So like we said, you had theoretical 101 plus leverage. By the time it's made that 5% move to 255, we're getting a 300% target on the rest. That's actually only about a 60 to 1 leverage effectively, because we've lost a day and a half of time. But it's not that much time lost relative to that we have plenty of time left. But you see, you get the point that you're taking advantage of that powerful thrust, that takeoff point in Apple, and then you're riding that rocket ship into not just the first day where you sell half your position. And in this case, you would have a day trade. By selling half your position at double. Guess what? It's a very happy day trade. By the way, I don't know if you saw the news as well that they're talking about that the $25,000 minimum account for day traders who are active is talking about being cut down to just $2,000 minimum. So I think you're going to see a further explosion in option activity as that ultimately gets approved. So keep an eye out on that news as well. But we're not generally targeting day trades. We certainly won't have enough day trades to ever cause a problem for any size account in this portfolio. So the idea, though, is that, hey, if I can get my risk money back and your risk money back in a matter of hours, yes, I will do it happily, and then free you up to say, I'm gonna sleep real easily that night and in future nights, knowing that I can't lose, and we can't lose on that Apple trade going forward when we sold half of it at a double or better. So total trade generated $1,512 in profits. Like we said, you'd be 11 contracts in, 11 contracts out. So that $1,512 is before commissions. You might have a maximum of $22 in total commissions, $11 in, $11 out, no ticket charges, even as we break these up into smaller partial exits. So remember, too, that every time we trade Apple, we're going to have times where it wins, times where it loses, right? Their past performance is no guarantee of future results. But the big objective here is to say, when we win, we want to win bigger. When we lose, we want to lose smaller, right? That's the idea of options buying is that we don't have to have a super high win rate if you can just make sure that you can win reasonably big, and then when you do lose, you just keep your losses relatively manageable. That's why a lot of people come to me and ask, the first question I ask is, what's your win rate? And that's only part of the equation, right? Win rate is important, but size of win versus size of loss on average is just as important in the calculation that we measure called profit factor to determine, is this a trade worth taking in our system, right? We want both of those things to be working as well as they can. Win percentage and bigger wins and smaller losses make up that profit factor. So the point of this is that we're going to show you a bunch more examples. You say, how did I find that trade? My team and I are always scanning, okay? Now, in this case, a lot of our scans for Grand Slam options are run right into the first hour's close of the trading day. So you're going to see most Grand Slam trades happen, pretty much all of them I'd say happen, right after that 10:30 a.m. Eastern time window, after the first hour's under the belt. You say, why would you wait for a whole hour when you see something breaking out? Well, you've seen it all the time, right, where you get an initial breakout that it turns into a fake out, right? I mean, we've seen loads of even what look like good earnings initial gaps in your favor that then flip on you, and you say, well, who's really winning the war relative to where the stock opened? We want to see what that first hour tone is, that we're seeing continued buying power, and that both of those indicators are breaking out together into that first hour's close, because guess what? That's likely going to motivate the institutions to want to keep continuing to get more and more of a position. It tells us that there's a buying power that's continuing off of the open, not something that's being sold off the open, okay? So we're looking at both those indicators, the Commodity Channel Index, or what we call the CCI, and Larry Williams' percent range or percent R indicator. I use it in a very different way, and I know Larry, and Larry Williams is a great trader and innovator in the trading space. But the idea is that we noticed this pattern a while ago that, things that break out and keep breaking out are no longer in a range, right? They're trending, right? So our percent R kind of converts to percent T. The percent trend staying in that top 20% of its readings is a very good thing. And we're going to show you more examples of why we want to combine those together. But, true Grand Slam trade is one that gets all of the targets, hits the ultimate four bagger, the 4 times your money on the final 300% profit target. But let's face it, not all trades are going to get to all of those target levels. This is why we take half out of the double, in case it doesn't fire the rest of the way, or only part of the way, right? So here's one on Citigroup. And one of the great things about this methodology, folks, is that you see that we're going to talk about a lot of names. We just talked about a tech name with Apple, but we're also going to talk about a lot of names that are non-tech. Because as you know, the options market has an assumption about how volatile that underlying stock is based on that stock's past volatility and price movement, right? So when they know that it's been a wild and woolly tech stock, guess what you're going to pay for the option, a lot or a little? It's going to be a lot comparatively, right? That's called a higher implied volatility. Compared to when you trade Citigroup or a bank stock, you're going to pay a lot less because they assume that Citigroup is not going to have that type of overall price movement. But yet, even before I look at the chart indicators down below, when you go back and look at the consistency of Citigroup's uptrend here, right? Steadily higher highs, steadily higher lows. That consistency of that price channel, that nice tight overall movement, is actually gold in my book for buying options that are out of the money, because that's going to be options that historically will be underpriced. The options pricing model does not expect trends, especially not persistent, steady trends like Citigroup was displaying here, right? So that's one of the first ahas there, is that's how you can get an edge against the options pricing model, what we call often the hole in the Black-Scholes. The Black-Scholes folks, they won actually the Nobel Prize for their contributions to create the options pricing model, and yet they also ended up, a couple of them went on to long-term capital management and ended up bankrupting that massive hedge fund, almost took down the financial system in the late 90s because they were betting against trends. They were betting that trends will not persist. They were betting on what's called mean reversion. Anyway, that's a story for another time. Great book on that called When Genius Failed. Roger Lowenstein wrote that book. That's a great one to read if you want to learn about long-term capital management and some of the flaws in their methodology. But point being that that flaw is, flip it around, your opportunity to beat the system, beat the model, beat find that sort of missing element that the model assumes. Well, trends don't exist. That if anything, the only thing that they plot for is basically the carrying costs uh, of an option relative to the current interest rate. So rates have risen a little bit from where they were 5 years ago, right? So, or 3 years ago at least. So the bottom line is that, yeah, there's a little bit of a carrying cost embedded that wasn't in there a few years ago, but it's still minimal compared to the fact that you catch a trend right, you have a major edge against how options are being priced. So that means in uptrends, call options are systematically underpriced in strong, steady uptrends like this. Okay, they need to be persistent though. They can't be brief. They can't be they can't be slow either. You need steady, persistent, healthy price movement. So look what's happening here again. That's a big lead in too. Okay, the concept, which is that we're looking to take advantage of that big breakout, first hour close on Citigroup on a Thursday morning, first hour in, right? We don't chase it off the open, but we see strong, persistent buying that pushes both the CCI in blue and the percent R in red, both up above their breakout levels. And point being that they're both breaking out together. One can't be broken out and then the other break out later. That's not like showing us that change, that breakout point happening kind of coincident. It's like we want two rivers flowing together into one more powerful river at that in conjunction there, that point of meeting there. And so it's like, okay, there's a lot of power hitting together, and you can see that first several days, it's just very, very persistent. That was a Thursday, Friday, Monday, Tuesday. We're waiting till Wednesday to get our profit target. And you say, well, what happens if you go through one of these sideways phases while you're waiting? Okay, that's a very valid point. What do you do while it's kind of chopping there on that particular day, on that Monday into Tuesday morning? We're measuring everything on a relative to our entry point basis, right? So our entry level on Citi is just under 98 bucks. Okay, so what you want to see is that it stays over 98 bucks each subsequent afternoon after we get in. So if we get in on a Thursday morning, we do not put a price stop to start this trade. We say if on Friday afternoon, the next afternoon after we got in as a first checkpoint, if we're below that about $98 level, we're going to say that get out. It's not moving like we thought. But you can see now it's up to 99. Check mark, stay with it. On Monday, it's back to maybe just under 99, but still above 98. Check mark. On Tuesday, it's already rocketing up, and Wednesday we're hitting our target. So the point is that we will hang with that trade, even if it's kind of slowish at first, as long as it's not against us in a future last hour of a trading day, any next day or thereafter last hour. So that's what we call a time stop. That's an important distinction to make versus price stops. When you're buying at or out of the money options, you're buying all time premium, right? So you cannot afford to get whipsawed by something that's essentially working, even if it's not working maybe as fast as we would all hope on every trade, right? They're not all going to be rocket ships immediately. But the idea here is that if we've got that ability to say it hasn't gone against our initial buy level, then it says that it's still working its way higher. And sometimes it's almost like climbing stair steps, right? You can look back and see some of those. This one's pretty vertical, right? But you can still see some of the stair steps, right? We get up here, then you got your stair step. Get up here, a little stair step. Get up here, a little stair step. Get up here, and then it kind of violates that stair step. We're long gone, actually, by the time that violation happens at the end of the chart. Our first target is hit. You can see this one took 4 days. So usually these trades can go very quickly, but in this case, they can also last, in this case, for almost a week and a half. First target hit at 100%. Notice the stock has risen to as high as 102. It's still well out of the money. We bought the 110 calls in September. We bought the 110 calls, and we only paid 55 cents, 55 bucks a contract, right? So that's a real cheapie. We usually don't like to pay them much under a half buck. If you start buying them too cheap, your odds of success start to diminish, and you just don't get enough win percentage to keep people in the game for the long haul. And so that's something we are very careful about. Here's target 2. It turns out to be right near the highs, up near 105.5. Now we're still 4.5 points out of the money, but our 55 bucks a contract is now worth 165 bucks a contract, right? We've seen the inflation in that. And then as it rolls over and it actually does stop out here, just under 100% on the final piece, 96%. We tend to use a trailing stop. Once we get up, say to 200%, we'll move our remaining stop up to about half of what, about 100 percentage points really under what our peak was. So when we got to that double, we would tend to move our stop on the rest of the position up to a price stop of a break even on the rest, right? So that way we can at least get an average about a 50% gain if it doesn't fire. That generated $1,250 plus in profit off of gross, off of, in this case, we probably would have gotten about 18 contracts in, 18 out, so maybe $36, more than $1,200 of profit on the whole trade for less than 2 weeks of work. Here's a faster one on Upstart, and let me go back to the time stop concept here, because look what happens here. We get in on a Monday morning, gap up, Upstart, UPST, FinTech, financial technology play, right? We're buying right near the short-term top initially, okay? A lot of places are going to tell you they're right all the time, and they never buy it at anything but the absolute low point, and that's just not reality trading. The reality is you're going to have times where it still has to go through this back and fill after a breakout, right? That's not unusual. But you can see what happens here is that the first day it backs off, right? We're in to Upstart calls up near $66. That first day, it drifts down, finishes about 64.5. And the next morning, we're in on a Monday morning. Next morning, Tuesday morning, we're down to 63. And you're going, oh, man, we're off to a bad start. Are we getting stopped out yet? No. What's our first checkpoint? If we got in Monday morning, it's the next trading day, Tuesday afternoon. So you draw a line up here Tuesday afternoon. You say, okay, now where's the stock Tuesday afternoon? Now it's about 67.5. Check, you hold the position. It's above $66 where you first entered. If it was below 66 on that Tuesday afternoon, we would have said, you got to say bye-bye. It's too slow of a boat. We want to be on faster boats than that. So then we're able to hold on. And then the next morning on Wednesday morning, just 48 hours later, we're ringing the registers. It pops up here to as high as 72. Notice we had the 77.5 strike calls. Okay. So you get the idea. This was a June entry signal. We bought the July monthly, third Friday of July is how the monthly options work. So we just had the October monthlies expire this past Friday, October 17th. So the point of this is that this was a July expiration, but we can see we're out just a couple days later at the first target of a double. Second target of a triple happens just a few hours later when it pops up to about 73. And then you can see we actually get faked out on this little pop down. Our trailing stop gets hit on the last piece at up only 78% as it gapped down and opened us out at that just under our 100% gain trailing stop. So got a little bit below that stop level. Still made $1,156 in gross profit. We paid $92 a piece. That would have gotten you 10 contracts in, 10 contracts out, maximum of $20 commission on the whole round trip trade. Keep the vast majority of what you earn. So that's not a household name with Upstart, but it just shows you how fast they can move. The key here, though, was the time stop kept us in. It would have, a lot of other people would have gotten cold feet and bailed too early. That's not what our system does. Here's another one with Schwab where it got off to kind of a slow start at first, right? We got a Wednesday morning entry, May signal, June option we bought, June 90 calls when the stock's about 84. You see, you don't have to go as far out of the money on a non-tech. See both of them firing on that Wednesday morning breakout there. So again, we get in here and then we deal with the first day's sideways to slightly lower drift. Second day it pops up. You can see it's settling back in here, but still above our entry level by the end of that second day in the trade. That next morning, on Friday morning, you can see we're actually briefly negative versus where we bought, but by the end of the day, look, it's back up. Check mark, you still hold the position. You would have thought you would have gotten filled in that gap up that next morning, but we just missed getting filled there. But you can see it's still grinding sideways to higher. And by the time it gets our target one here, 100% gain, sell half your position. Notice what we paid for the 90 calls. They're about 6 points out of the money on an $84 entry price on the stock. We paid $77 a piece. So you can see that would get you about 13 contracts into the trade. And you can see here that 12 or 13 contracts in, you can see in this case that I think it's 13, that in this case 100% is made on the target one, Target 2 turns out to be right near the high and right near the strike price, right? We bought the 90 calls and it got up to 89.85, right? So a lot of times the at the monies will hold the most time value. So you get what you're seeing happen is some premium inflation, even though you say, well, I've lost a week and a half of time while I'm waiting for this thing to move. And yet it's still hitting a 200% gain when it pops up near the strike price. And then as it rolls over and we get a little gap underneath our 100% trailing stop, we're out at 70% on the final quarter of our position, $1,086 in profits on all these trades, no more than $1,000 put in, right? So trades that can cumulatively double plus, and even when they don't hit all their targets. Now, how about when it didn't work out? What do we do when it's too slow of a boat? This is one that we had traded a while back on Fluor Corp, the big construction giant, FLR symbol. There's our breakout, right? We've seen everything ready to go here, feeling pretty good about it. And you see it just gets in this flattish mode here and starts drifting a little bit against us by the end of the second day in the trade. We're saying, well, it's not much of a violation, but hey, guess what? Technically, even a few pennies underneath where we got in is still a violation. We said, look, we're in near 34 and a half. We're sitting about 34 and a quarter. That's too slow. We're not liking that waiting mode that we're in, buying an out of the money, about 10% out of the money option, right? Stock was 34 and a half. We bought the 37 and a half strike calls. We paid $66 a piece. We closed them out closer to $50 or maybe $55 a contract, and say, okay, we're taking that loss, and you see it ends up rallying later, but I don't care. There's always another train leaving the station with the market. There's so many different opportunities. Why should you be stuck on a slow boat when you can get to your goal and your destination a lot faster somewhere else? So that if we only could trade Fluor and that was the only stock that was tradable, sure, we'd have to come up with a whole bunch of other strategies to trade that one vehicle. But that's not what we're dealing with here, right? You have an opportunity elsewhere, and there's an opportunity cost if you get stuck sideways, especially with the time erosion of options, to say you can't afford to sit and wait. Okay, I tend to be a pretty patient person, but I've become much more impatient as a trader and saying no, that I'm not going to tolerate flatness. If I gave it the 2 trading days and it gave it a chance, it didn't go. Sorry, window is closed, opportunity gone, we're moving on somewhere else. Take the 17% loss in that example and say better to preserve the bulk of the capital and move it on into a better situation somewhere else. How about some examples that hit all of their Grand Slam trade targets? Here's one with Roblox, RBLX. Roblox has been a pretty much a red hot stock. We caught a good piece of it here a little while back. You can see that it was starting to break out. When the stock was about 64, we were buying the 80 strike calls. And this is something that I've adapted even in my 36 years, I guess, of options trading now. I got started trading options pretty much while I was, as I was just getting out of Duke University, and I'd already gotten attracted to stocks, but saw the power of options as I got out and learned options real quickly to say, wow, it's just so much potential there to do so many different things, whatever your objective is, whether it's growth or income or protection or you name it. Love the flexibility that options gives us, right? But here's one where I used to be afraid of buying these out of the money options. I used to think, well, it's 64. I'm saying it's going to move to 80 plus. And I'm saying, well, we don't have to get it to 80 plus, right? We just have to get it up enough that we can sell half our position at a double and then try to ride the rest for the triple and the quadruple. So in this example, it took a little while, right? Remember I mentioned that stair step idea before, but what we liked here is that while on day one, this is why we don't get out on day one, right? On day one, it was slightly below where we got in. We got in near 84 and finished near, 64 and finished near 63, 63 and a half. If you use the first day as your criteria, you'd get whipsawed out of a lot of other situations while they're kind of catching their breath after that first breakout sometimes. But sometimes they just keep rocking and rolling, so we don't want to get left at the station. We want to get on board the train even if we have to wait a little bit. So next day it rockets up, and then you see all these other pauses that happen throughout that next week are still staying above there, including these little fake outs, put a little V on those opening lower fake downs, and then the big snap back up. This is why you wait till the afternoon. We'll put an A on the afternoon that same day, A on the afternoon that next day. Say you're still above where you got in here. And that's what counts, right? You're sitting now in the 67 zone. We got it at 64. You say, well, we've got an 80 call, so that's why we're not getting our target yet, because it still needs to get going a little more than that, right? So when it finally gets going up here to about 68.5, we're getting the target one hit there for the 100% gain, right? So we paid $79 a contract for those 80 strike calls, and it's been about almost 2 weeks, right? We got in on a Wednesday. It's a late Tuesday. We're two weeks later, almost 10 trading days in the trade, and we finally get our first target up near 69. Rallies on up to 71. We don't get our second target until it gets to about 72. And you can see, remember, we got an 80 strike call, and then target 3's hit near a 75. So you say, well, geez, that took like 3 whole weeks. This is why we buy at least a month out typically, right? Because we want to give ourselves enough time to let a trend continue to evolve in our favor when it's working, right? That those little pauses that refresh did not flush us or fake us out, right? We let the price action tell us that the stock is still getting accumulated. Even though those little spike morning dips lower, it rips back up in that first hour's close, right? You get that big reversal, that big tail left where it shows you that there was buying interest into those dips. And that's what you want to see, right? You want to see the buying interest being solid there. So $1,700 plus in profit because it hit all its objectives. Now, sometimes I mentioned rocket ships that just never look back, where you wouldn't want to wait for a retracement. Here's one with AMD where we popped in after that big gap up. A lot of times you see that big green candle right here that's giving us our signal near the close there, and you say, oh man, I've missed it. You know, it opened just under 180. It traded almost to 185, and you're telling me to buy it at 185 or 186 on a 260 strike call so far out of the money? We're saying yes. We are telling you to do that because we're saying you want to be a part of that inflation in the stock and the inflation in the option premiums if we're right about the stock continuing to rally. AMD's historically been very good on our system. So we said, yes, we want to take advantage of it. Look at how much it makes higher and higher lows. It's almost no new low versus the prior hour, right? And higher and higher highs for the most part, right? You got a little pause right there, and then it ripped on up. So target one was hit the next morning. You know, we bought those well out of the money options for just $76 a contract. And we're already ringing the register over $1.50 when it rips up the next morning to nearly 200 soon after the open. So we're at 110% in the first half, get a guaranteed mild profit, even if the other part doesn't keep going. But in this case, it does keep going. The next day, we get target 2 and target 3, the 200 and 300%, just 48 hours into the holding the position, and we're out there that following day at gets up to 210, right? It still didn't get anywhere close to the 260 strike price. And yet, because it went from that mid 180s up to 210, that's, you know, a nice 25-point move in just a couple of days. And so we don't know that it's going to reverse, which it does the next day. It comes back down a bit to 200. But the point of this is that, you know, we're saying, look, just ringing the register. Remember what I told you about the ideal pattern? The ideal pattern is staying in the overbought threshold. That's percent R in red. The blue CCS stays in the overbought threshold with just a couple of retracement retests there. So it's really, that's the ideal pattern that we want to take advantage of and have you riding those rocket ships whenever we get the chance. Now, what happens if you look at all the trades we've called out for our Grand Slam options subscribers? In this case, it goes way back to the beginning of 2017. This is one of our longer term portfolios that we've had for a number of years, right? So we've guided a lot of folks through, and it's been one of our most popular strategies. In fact, to the point that we had shut down Grand Slam options not too long ago because we just felt like we were getting enough people in it that we didn't want to cause any problems for subscribers who'd already invested in the program. More on that in a minute, because I've freed up a few of those spots for you today with some bonus trades that we developed as part of our sister service called Grand Slam Extra. More on that in a minute too. But you see the Grand Slam options historical performance. If you took a $5,000 starter account, you would have taken up to over $30,700 in total value or 25,733 in gross profit, going back to the beginning of 2017 through today on all closed trades. Now, this assumes that you never grew your amount you allocated per trade. If you started with $1,000 a trade, you stayed fixed at no more than $1,000 a trade, even though the portfolio had grown from 5,000 to 30,000 gross before commissions and before subscription investment. So the idea of this is that we're keeping fixed on that allocation per trade. That'll keep you more stable than those that are trying to chase up their allocations on the way up. So as I've alluded to, Grand Slam option strategy currently sold out and unavailable to the public on our Big Trends website. If you went there on Big Trends, said I want to try a month for $297, say sorry, it's sold out. You can't get it. You can be put on a wait list, but you're not going to get access to it right now. So it has been our most popular strategy here at Big Trends. So popular, in fact, that while we had closed it, we were getting a lot of demand and interest to say, hey, can you get me some other Grand Slam type trades? So we went back to the well, created our Grand Slam Extra program. Same setup, but with different underlying stocks compared to our normal Grand Slam options focus list. So you get different trades, but the idea here is that I've held out a handful of these spots because I knew I was going to be doing this presentation. So in recent weeks, I've just kind of let those few spots just kind of sit there waiting for you here today. But also what I did, as I said, I want to give you extra bonus access to the sister service we developed a while back called Grand Slam Extra. So that means you'll get twice the number of Grand Slam setups, both the original Grand Slam options portfolio that's sold out to the public, but also the Grand Slam Extra bonus trades. So we expect to do about 8 trades a month in each of the programs. So we're talking about potentially up to 16 trades total per month. And if you look at Grand Slam Extras trades, you'll see the similar pattern, but on different names. Like here's Super Micro, right? It's become kind of another big beneficiary of the AI wave, as SMCI is a symbol as its work with NVIDIA and whatnot. So the principle of all this is that, okay, we want to take advantage of this uptrend here. So you can see our uptrend signal came way back here on a Tuesday. Notice these options are not going to be cheap, right? When we got our signal right off that big first hour shot up, it's just under or just over $47. We were buying the 54 strike calls, buying it for $93 a piece on average. You can see it rockets up here to the 52 range. When it makes that first move to 52, we're getting our first target out, selling half at a double. Right, we would have gotten 10 contracts at $93 a piece or $930 invested. We sell 5 of our 10 when it goes to $1.86. That's getting your risk capital back. And then when it has this big gap up here, we get our 200 and our 300% target, and it makes $1,581 in total gross profit before commissions, right? Commissions at $10 in, $10 out, maximum round trip commission of $20. And on all these examples, remember, past performance is no guarantee of future results. The principle was that, look, the first day we didn't panic when it went flat. We said, look, we're giving it to the end of day 2. By the end of day 2, we're way above where we got in, right? We're getting near our profit target that next day, and we get out on Thursday morning on one more rally up. Then we go through that next flat period, but now we have not gotten back to a break even, which is our remaining trailing position. Once we've gotten half out of the double, raise it stop to break even, give it a chance to keep running. It eventually does a few days later. So that's just another case. Here's another chip stock, Lam Research, LRCX. You can see Lam Research gets us that first big gap up, right? And you'd say, well, how is it possible that you're getting a signal when that red candle means that we close back down from where we open? We can see we're still way up on the CCI, and % is still just above its overbought threshold. So we go ahead and tell folks, look, we want to get in there. Stock's trading around 132. We're buying about 11% out of the money, buying the 147 strike calls out to the following month's expiration. And in this case, you can see what happens. Day 1, we're initially wrong, right? It drifts a little bit against us. Day 2, it rallies back up, pauses, but then by the afternoon, look what's happened. It's check mark. We're still okay in that final hour of that second trading day. Then it rockets up consistently on day 3. Steady as she goes to the first, second, and third targets, all hitting on day 3. 1, 2, and 3. You can see what's the stock done. It's gone from our starting point. It's about 11% of the money. We've got a 147 strike call. by the end of that Wednesday, we're already up to 143. We're just about maybe now 4 points out of the money or 3% away from that strike price. When we started out, 11% away, right? So we've had about an 8% move in our favor. That's good for eventually a 300% gain up there on that 8% rally after just 2.5 days in the trade. So it's a great spot to put yourself in to say, okay, when you can get to that risk-free, sell half at a double, let the next piece run to the triple, sell half your remaining half at the triple, and your final piece sold out at the quadruple. When you get the chance, it's a great position to be in. That trade generated $1,700 in gross profit for our subscribers. We paid $1 a contract or $100 a piece for investing 1,000. That gets you 10 contracts in, 10 contracts out at those various levels. Now, sometimes trades will gap even past their eventual final target. Here's one that we did on GE, and this was an earnings trade. So let me point out, with earnings trades, what we don't want to do is we don't want to hold and hope into earnings if we haven't gotten our risk capital back. So we will typically exit in front of earnings if we haven't gotten at least half out of the double before the earnings event is announced. So in this case, if it's not been called out, then we tend to want to say, okay, we're going to hold it if we've gotten half out of the double or more. We're not going to want to hold it if we haven't gotten that money out. It's not worth that kind of risk. So our strategy changes depending on if we've already taken off enough of our position to have lowered our effective total risk in the trade. So that was the thinking there. You can see that GE just consistent and steady as she goes, rallies on up, gets our first target at 100%. Then we say, okay, we've gotten our risk capital out here at the 100% first target there. So the fact that we're pausing here right before the gap up on the earnings, you can see we're pausing here, trading, in this case, just under 190, trading around 188. We're buying the 210 calls all the way back there the prior week or so. And you can see in this case that we'd caught in that first leg up, but we said, look, this is a trade worth holding the remainder of our position once we get our risk capital back and turn it into a free trade. We'd paid $63 a contract on the way in. We therefore got $126 on the first target, got our risk money back, and we said, this is where we want a free roll into earnings, right? When you get your risk money back, you're in a great spot to say, hey, what if it tanks after earnings? You cannot lose if you got your risk money back in your account selling half at a double. So if it completely gapped against us, we would come out, say the second half of our position went to nothing, we come out around a break even on the whole trade. Compare it to what actually happens is we get the gap in our favor as we thought, and we get, instead of a 200% gain, we get 301%, and then the final piece gets out at 542%. That trade generated $2,290 in total profit before the commissions, right? So the idea of this is that that's how you free roll into earnings. If you can sell half at a double or better, getting your risk money off the table, then you can hold into earnings. But if you can't, then I say go ahead and take what you can get and take the risk off in front of earnings. Here's another one on Palantir, PLTR, both of them breaking out together right into that first hour close. We're hopping in there right at the start of the second hour, and you can see this one takes a few days to get going. So by day one, sitting there, day two, still sitting there, and then you see it starting to work its way up. So, from that perspective, we're saying, okay, look, this is an opportunity to say, even if we don't get off to the blazing start like AMD did, we have the opportunity here to still hold and look for that trade to work as long as it doesn't hit our trailing stop criteria. We can give it a chance to keep going as needed. So that kind of walks you through how we think of things. Even in a name like Palantir, you can see even as it was slow at first, it eventually gets target 1, the double, target 2, the triple, target 3, more than the quadruple, 366% gained, generated a total of $1,800 in gross profit, and still did it for an incredible value, incredible bang for your buck. So how can you get these real-time trade alerts for these Grand Slam strategies? Let me first kind of walk you through the typical pricing for a 12-month subscription to Grand Slam Options. We mentioned to you that if you looked at our Big Trends website, if you were able to get in there, it was $297 a month. But that means 12 months would be pushing towards like over $3,500 in value, but we're going to make it a lot more attractive for you than that today. But you're also going to get access to what all the other long-term subscribers get access to, which is my Grand Slam Options strategy session that I did. It's a special video for subscribers only that walks you through the settings and rules. You get the settings and rules sheet so you can follow along as a home gamer and trader. And then you also get the weekly video training that I do that's posted every Monday at 6 p.m. So I have another one of those coming in later today. We also give you dedicated email access to reach me and my research team anytime you've got a question about any trade that we've called out. So a year would be over $3,500 of value. Now that's just for Grand Slam Options. Grand Slam Extra, same thing, right? $297 a month, same strategy sessions, same settings and rules, same other pieces. Grand Slam Extra, another $3,500 of value, right? So both of them together for a year each adds up to more than $7,000 of value. But what I've done today is I've taken that way down, plus I'm throwing in extra bonuses like the first 17 buyers today that get these spots that I've set aside, up to 17 spots, will also get an extra bonus, a multi-hour options bootcamp course training. I call it my Gamma Options Bootcamp. It's a $295 value. You can see we walk you through why Gamma matters, what Gamma is all about as an options pricing variable, to say that you can pick up a lot of bang for your buck as you ride these big trends, right? We're not into the game of scalping for small micro moves of 20 or 30 or 50 bucks at a time, right? We want to make the bigger money of potentially you put in 1,000, potentially making you well over 1,000 on trades that hit multiple 100, 200, and even 300% profit targets. So we walk you through all those elements of the Gamma concept and why it's so valuable, why it works so well as a momentum trading strategy to put the odds in your favor over time as an options buyer in the Grand Slam strategy. So we walk you through that. You get it, and that's a lifetime access actually to the boot camp training. You can watch as many times as you want. So today's offer is a phenomenal kind of doubling up of Grand Slam opportunities. You're getting the original Grand Slam options portfolio, plus you're getting the Grand Slam extra trades that we developed. Each of those should generate up to 8 trades a month. So we're talking about up to 16 trades combined per month times 12. So a ton of trading opportunities over the next year. That would usually be a $7,100 plus value, and saying, hey, if I take it down to $997, that's typically the lowest I would price it at, because I like to price my services for the fact that one trade with $1,000 invested could easily pay for your full subscription. So if you paid $997, one trade that hits all 3 targets could make you $1,700 or more, and that could not only pay for your subscription, but leave you a lot of extra left over. Well, what I'm going to do is I'm going to do one better than that. I'm going to give you a special promo code today, and the promo code magic word is GRAND. It'll take that $997 down and cut it in half again, take $500 off with the promo code GRAND, and take you down to 12 months of each access. We're talking about in the next year, you'll get, like I was saying before, somewhere in the neighborhood of, I'd say about, in the neighborhood of about 180 trades, something like that, almost 190 trades, but point being, almost 200 trades. But bottom line is it's still phenomenal value getting that many trades and only paying $497, where one trade can easily pay for your entire 12 months of both Grand Slam portfolios, right? Combined off of just one winning trade. So that's why it's got to expire at midnight, and it's just 17 spots, and that's where you go to take advantage of it. It's bigtrends.com/grand. I'm going to pick up some questions here in just a minute, but I want to show you how to apply that coupon first. bigtrends.com/grand. I'm typing that in your chat box here so you can make a note of it as well. bigtrends.com/grand gets you that, but you got to use this promo code and show you how to type it in. Promo code magic word is GRAND. Okay, so let's go to that page and show you what you need to do here to lock in the extra $500 off. You'll see when you go to that page, bigtrends.com/grand, I'll pop this up. It shows you you're getting both Grand Slam options and Grand Slam extra together. Both of them together would be typically $7,000 over a year. Even if you got it at $997, that would be a great value. But guess what? you have a promo code. I just gave it to you, right? You remember what it was? If you've forgotten it, we even put it up here in the text. Use the promo code word of grand. Sometimes what I'll do is I'll just copy it and paste it in that way. Say, hey, paste in grand and hit apply over here. And bam, takes the extra $500 off your $997, takes you down to the one-time investment, no future charges. One-time investment of only $497 locks you into not one but both of the Grand Slam programs for the next 365 days. So that is a phenomenal value to get not one but two programs, two times as many Grand Slam opportunities as most people get for actually just over half off of what the typical best pricing would be at $997. Takes you down to only $497 when you type in that promo code word GRAND, GRAND, right? So if you have any questions too when you're getting your order in, that's a secure page. You can call us toll free at our 800 Big Trends number. Just spelled out right there. I'm just going to go ahead and copy and paste that into your chat box here. 800-244-8736, or just remember 1-800 Big Trends. You can also email my customer service and client care team by going to clientcare@bigtrends.com, and they can also get you more information if you've got any questions. That is a secure order page, so you can put your payment info in there. We use Visa, MasterCard, American Express, Discover. Put all your billing information over on the left side. Remember to get your email in correctly. That's very important because that's the first way we're going to communicate with you. Now, the other thing too is that, guess what? If you want to save yourself some time, when you put your information in on that page, you just review the terms and conditions here. They're hyperlinked right there. Click through, see how we've been doing business for 26 years and counting, serving our Big Trends community. Hit I agree to terms and conditions. When you reviewed it and complete your purchase, you'll be good to go. Or if you want to save a lot of time, not input any data there, once you've got your promo code at least in to save you the extra $500 off using promo code GRAND, then you can click through to PayPal, and that's another way that you can make sure you lock it in with just a few clicks of your mouse, right? Then you've locked in the extra savings offer, the just the big value here, and not having to type in so much. When you hit the orange PayPal button, it'll take you onto PayPal and let you lock that in. Note, we're giving you, if you're one of the first 17, the lifetime access to the Game Options boot camps. You do not need to add that to your order. We're going to throw that in as an extra special bonus, so we're saving you extra money there, so you don't need to add that in. So you're getting both the Grand Slam Options 12-month alert service and the Grand Slam Extra 12-month alert service. So really phenomenal value here. Great way to save and a great way to start putting plenty of new, fresh ideas into your portfolio. Look for those to come in via real-time email, and you can also get them as a real-time text alert. Typically, just after the first hour close, just after 10:30, we actually had one new Grand Slam trade here this morning that still is enterable, and you can take advantage of that when you get signed up. Remind us, we'll send us a note saying what's the new trade. We'll send you that trade we just sent out here just a couple hours ago, still actionable. Okay, frequently asked questions about Grand Slam include, what's our option strategy here? It's simple. It's buying options. In this case, yeah, they're going to be out of the money options typically because we're buying options for $1 or less, $100 a contract, controlling each 100 shares or less, right? So we're making sure that we're getting a lot of leverage. We're going a month out on the options. There are no spreads, no option selling. You close out what you bought. You never sell anything up front. So always will be priced at $100 per 100 shares per contract or less, right? So you're never paying more than that. So if you're following all of our rules on all of our profit targets, you could start with as low as 4 contracts. And if you did that, you would just set aside $400 a trade as a minimum starter point, because then you could sell 2 at the double, 1 at the triple, the last one at the quadruple when you get the chance. So that's another good way to think of it there. Start small and build your confidence by following the system. How many trades do you expect to get on average per month? We tend to say between 8 and 12 new trades per month on average in the Grand Slam Options portfolio. And so if it was 8 in Grand Slam Options, 8 in Grand Slam Extra, you'd be talking about 16 total trades that you're able to buy here today for an incredible value. How long we've been in the trade? A few days to a couple of weeks. We usually won't hold it that long, but when it's working, we will give it a chance to keep running. And then like I said, real-time email, real-time text alert will give you all stop and profit target levels. So you know exactly where to get in, where to get out on every single trade. So remember, just one trade could have paid for this multiple times over, right? The Apple trade that we called out when it started to move again, here you see the breakout on both the percent R and the CCI happening together. That's an example where, yeah, it's starting to, in this case, really have that persistence of trend, have that consistency, have that ability to keep running to the upside. So that's a big part of it too, is that it gives you that conviction to stay with your best ideas and give them a chance to keep running when they're working, even as you take off partial profits at the double or better. So like I said, 12 months of each Grand Slam options and Grand Slam extra, $3,500+ a piece would be over $7,000 in total value. We're throwing in the boot camp multi-hour training course with this as well to help you learn the strategy even better. And then in addition, you're getting the extra $500 savings code. Just use that promo code word GRAND, GRAND is your magic word when you go to bigtrends.com/grand. This will expire after midnight tonight or when those 17 spots are gone. So do not sleep on it. It's important for you to lock in massive value here and frankly get ready to start trading and taking advantage of today's markets, right? You can have lots of reasons when you read the headlines why you should be worried about the market, but that's a smokescreen, folks. That's going to throw you off the scent of the next big winner. It's going to leave you on the sidelines. And I don't want you left on the sidelines anymore. I want you taking advantage of fresh new opportunities, the next leader. And guess what? We're not always going to be right. There's times if we're wrong, we'll cut and run, we'll preserve capital, we'll move on if it gets stuck on that flattish chop situation the next afternoon or any following afternoon after we get into a trade. We're going to remind you, hey, cut and run on this when it's not moving. So you're never left wondering what to do. We guide you through every single trade, win, lose, or draw. And that's why Grand Slam has been such a popular strategy for so many years, and why I set aside just a limited number of these spots to allow folks to start taking advantage of them. And guess what? You all see that value. We've got a bunch of people already locking in the value. So thank you for the people who are already now locking in both a year of Grand Slam options and a year of Grand Slam extra, including William B. down in Florida. Thank you, William B. We appreciate your business, as well as Michelle D. for your continued support. Thanks, Michelle, out of California. Sadaji, appreciate your continued business as well from Florida. And Meyer from over in Israel. Love the international way we can reach folks from all parts of the world. And definitely look forward to serving you, Meyer, with real-time trades, even coming in from Israel, right? We're going to send them out. And typically after that first hour Wall Street time, about 10:30 Wall Street time here, 10:35 at the latest, we're getting alerts out to subscribers saying, buy this option, get in up to this price. And then we're sending you follow-ups to say, okay, now here's your profit target. We'll remind you when your time stop is. We'll remind you what the next target is once we get the first target. So we're constantly guiding you. You get the benefit of me and my team being your eyes and ears and fingers typing away at you to tell you, hey, it's time to get in, or even more importantly, when it's time to get out at a profit target or when the time stop hits, right? So we guide you every step of the way. That's what I really pride ourselves on here at Big Trends, is saying, yeah, we're a credible source of information. We're not just throwing a bunch of stuff against the wall and only talking about what worked. We're constantly guiding you with meaningful, specific when to get in, when to get out on every single trade. So I'm very appreciative of this continued support. And our goal is to really always be there for you too. So, if you've got a question, we'll answer it, right? If it's about a winning trade, it's about a trade that didn't work, right? We're not gonna hide. We're gonna say, okay, this is what we did on this one. This is what we did on that one. This is why we called it out. This is why we got in. This is why we got out, right? So and I do my constant updates as well. So we're basically always telling you about what we're expecting next for the markets too. More orders coming in, including Michael P. from Virginia. Thank you, Michael. Appreciate your business as well. It's really all about continuing education too, right? So you've got all these support resources to go with the real-time entry and the real-time exit instructions. So we'd never leave you hanging, but you know what we're thinking because you've learned the system. You don't have to do the work though. We're running the scans. We're calling out the best of the best trades at one at a time that we think you should get into at each moment. so you're not dealing with a whole lot to do. It's a matter for you of your main objective once you've signed up to the service is that all you have to do is just execute. When we tell you it's time to get in, you go into whatever brokerage platform you want to use using the simplest option strategy, just buying the option, right? No spreads, no margin account. It's like you can do this with a just simple cash account, really simple, really clean, really easy. By the way, some brokers let you trade options in your IRAs, your retirement accounts too, especially when it's simple like this. You check with your broker on that too if you haven't already looked into that. But the bottom line is that loads of different ways to put it to work in your portfolio with ease of execution. Just be consistent. Don't get too high. Don't rush in and load up on the very first trade that you get. Look at this as a longer term plan, right? I'm giving you 12 months of each to give you loads of opportunities, and I want you to diversify. I want you to spread yourself out across the number of trades that you get and not try to put all your chips in on any one trade. Never do that. You know, in 36 years of options trading overall for me personally, it's like, hey, that's where you can get yourself in trouble when you load the boat, when you get too heavy on an idea. It's more about the slow and steady wins the race and saying you've got plenty of leverage, right? You don't have to be a hero. You just have to be consistent in your execution. When we say to get in, get in. We say to get out, get out. Whether it's a winner or whether it's a loser, whether it's a time stop, whether it's just basically not doing what we want it to do. It's to clean it up, move it on, or let it keep working if it is working to your first, second, and third targets. 100, 200, and 300% target profits is what we're after with this game. We'll guide you through if it gets there or if it doesn't, when to clean it up and move it on each and every way. So a question came in from Meyer. He said, so do we buy the next month option at the beginning of the month? When do we buy the current month option? Okay, closer expiry options move quicker. That's true, Meyer. But guess what? I'm not buying anything in October right now. Here we sit, October 20th, 2025. Right now we're buying November monthly options. Those are November 2nd, 17th expirations. You're just about a month away. We will never hold it past the first Friday in November on a November expiration. So whatever the monthly expiration is we're buying, we won't hold it past the first Friday of that month as the latest we could hold it, right? So the idea of this is that we want to put ourselves in a position to catch that leverage, that gamma effect I'm talking about that you'll learn about, because guess what? All of you that are buying here are getting my boot camp course thrown in as an extra bonus, multi-hours worth of training that you can watch as many times as you want at whatever time suits you. You can watch it 2 in the morning if you want. You can watch it day or night. Yeah, and you can also, by the way, you'll get a dedicated email to reach me and my analyst team if you've got questions on the material. We'll answer questions on anything that wasn't clear to you from the material as well. So the idea of this is we want to keep educating you. We want to keep growing you as a trader in addition to helping you grow your portfolio and manage your portfolio well through both the ups and the downs, right? The idea is that it's about proper management. Trade management is a big part of the secret of staying in the game, right? Knowing not to get too high or too low, knowing to be consistent in your capital allocation, knowing, okay, when it's not working, you don't hold and hope. You don't ride something out to a total wipeout. It's like saying no. It's like, okay, it's not working. It's time for us to clean it up, move it on, right? So we're going to guide you every step of the way on every single trade with the Grand Slam Options 2 portfolios you're getting, both the original Grand Slam Options service and the Grand Slam Extra for all the bonus trades you're going to get too. You're doubling up your Grand Slam opportunities while slashing your price point down to a one-time investment of only $497. Don't know how to make it more attractive than that. So Bill B, good question, says, do we send the trades via text as well as email? Yes. When you get signed up via email, we're going to send you, Bill and others, your follow-up email you'll get is to say, here's how you set up your text messaging. We use the WhatsApp technology. It's a really clean and easy way to do it, and so we can help you with that if you have any problems with it. But we'll send you instructions on how to get set up to get all alerts via text. At the same real-time moment that we send an email, we also send a text. So I personally find the text is actually the even more immediate thing that you're going to see first. If you were saying what's going to get to you faster, you're probably going to see a text hit your phone, pop up in front of you even faster than having to periodically check your email. Right. So my view is definitely make sure you get it set up for the text in addition to the email. So what do you do right now? You go to that link. It's bigtrends.com/grand. Make sure you use that promo code. Promo code word is grand as well. So when you type grand in the promo text box I showed you earlier, that will save you an extra $500. They'll take the $9.97, you apply it, they'll take it down to only $4.97, but only through midnight if there are still the remaining dozen or slightly less than that spots now that are they're getting snapped up. Don't sleep on this. Spots are already going fast, so do go there right now. It's bigtrends.com/grand. If you have any problems whatsoever with your order page and locking in one of those remaining spots, call us at our 800 Big Trends number. You can also email us clientcare@bigtrends.com. I'm going to type that link in one last time to say that's your action point to go right now and lock in one of these last remaining spots. bigtrends.com/grand. I look forward to serving you with doubling up the Grand Slam opportunities with getting a year of both the Grand Slam options and the bonus Grand Slam extra trades. $7,000+ of value, yours for more than 90% off, but only if you act quickly. bigtrends.com/grand. Thank you for taking your time with us. We'll be there for you. We'll guide you through every trade, win, lose, or draw. So that's what now 26 years and counting. Why I think people keep coming back to Big Trends, because we never leave you hanging. We guide you through every trade, and that's just our commitment to you to make sure that you're getting the maximum value out of the program, and that guidance from the beginning to the end of every trade, never leave you hanging. So thank you so much. Look forward to more that are locking in this value. So look forward to serving you, Michael, Meyer, Sadajit, Michelle, Bill, and more. That's what we're there for, is to help guide you through that. So thanks to each and every one of you for locking it in, and look forward for more coming in to help guide you every step of the way. Sadajit, my pleasure. Thank you as well for your continued support. We appreciate you for your long-time business, Sadajit. So that's what I love to see. Long-time subscribers keep coming back for more. They see the value. They know we're there for you. It's not a bunch of hype and hope, right? It's about creating a system, following a system, and then helping you to execute it consistently. Through what seems like at times the chaos of the markets, we provide the order, the instruction, the clarity about which names give you the next fresh opportunity for potential Grand Slam options, home run type of upside, and controlling your risk each and every trade with the time stop, no matter what. So we're there for you. So look forward to you taking advantage of it. I've got to run. Thanks for being with us. It was a lot of fun. I went longer than expected, but I really believe in this program and have a lot of confidence that you're going to be a very happy subscriber, like so many of our other Grand Slam traders are. So lock in one of these last few spots before they're gone, and keep trading well and staying well. See you again real soon. Take care. See you next time.